Hello, welcome to today's webcast sponsored by OJM Group, Pain Relief for next April 15th. My name is Carole Foos. I'm the Director of Tax Planning here at OJM. OJM is a registered investment advisor, registered with the SEC. Today's webcast is not meant to be personalized investment advice, nor should it be considered personal tax or legal advice. We're going to talk today about some general concepts for tax planning for this year. Any advice or concepts that we talk about should certainly be discussed with your own personal advisors prior to implementing anything. So we do want to thank you for joining today. Many of you, I would imagine, recently filed your 2013 tax returns. Some of you may have been unpleasantly surprised by the effect of the tax law changes that were signed into law at the beginning of 2013. Many of you, I'm sure, saw an increased tax bill as compared to what you had seen the past few years. So a few of the topics that we want to talk about today will include what surprises did you find in your 2013 Form 1040? What are some of the 2014 tax changes that you will see coming up? Also, we're going to discuss what has been included in President Obama's proposed budget for fiscal year 2015. And then we'll discuss some ideas of things that you might do to ease the pain. First of all, though, who is OJM Group? We are, as I mentioned, a registered investment advisor, registered with the SEC. So we do investment management. We also provide comprehensive financial planning services. We are a multidisciplinary firm. We have attorneys, CPAs, investment advisors, certified financial planners. So we do retirement planning, we do education and college planning. We offer tax advisory services, although we do not prepare tax returns for our clients. We do work with their existing CPAs. We provide asset protection planning. Again, we do not prepare legal documents, but we will consult with clients' personal attorneys. And we do insurance planning and private client services. As a thanks for your joining our webcast, we do have OJM materials that we will offer free to attendees. We'll tell you at the end of the webcast how you can get those materials. You'll see on the screen now some of the books written by our principals. We have several books specifically for physicians. We do have a CME piece for physicians and a book written specific for orthopedic surgeons with a prominent orthopedic surgeon, as well as our book Wealth Secrets of the Affluent that will apply to business owners and other high net worth individuals. So what were some of the surprises you saw on your 2013 tax return that you either just filed or maybe that you've filed an extension for? First of all, many of you knew and have read about for the past year the additional 39.6% tax bracket. This tax bracket was put into place for taxpayers with taxable income above $450,000 for married individuals or $400,000 for single individuals. And while the tax bracket increase was 4.6% above the old top bracket of 35%, that actually represents a 13.14% increase in federal taxes on that federal income. So certainly that new tax bracket is significant, and for those of you who are well into that 39.6% bracket, you would have seen a significant increase in your tax bill. There was a new form that was in place for the first time in 2013, Form 8959, which assessed additional Medicare tax. What that form showed you on your tax return was that you're now paying 3.8% Medicare tax on your wages, which are above $250,000 if you're married, or above $200,000 if you're a single taxpayer. So under the old law, the Medicare tax was 2.9%. If you are an employee, half of that tax, or 1.45%, is paid by your employer. The other half is paid by you as the employee. Again, now, for those taxpayers who earn in excess of the thresholds of $250,000 or $200,000, the employee portion only has been increased by another 0.9%. So you'll now be paying 2.35% Medicare tax as the employee. If you're a self-employed individual, you'll pay that full 3.8% on your self-employment income above the thresholds. What some of you may have realized is that, under normal circumstances before this increase, if you were a W-2 employee, all of your Medicare taxes were withheld. So you wouldn't have been in a situation where you would owe additional Medicare tax when you file your tax return. However, what's happened now, for instance, if you have two working spouses and you each make under $250,000, but combined you make more than $250,000, none of that additional Medicare tax would have been withheld, so you would have likely owed it when you filed your tax return. And that was a surprise to many taxpayers. One thing that you'll want to think about for 2014 is adjusting your withholding or your federal estimates in order to avoid an underpayment for 2014. Underpayment penalties can be avoided if you pay in amounts based on your 2013 tax liability. So that's going to be something you'll want to look at and discuss with your CPA. Another new form that came into play in 2013 was Form 8960, the Net Investment Income Tax Form. What this form did, this was put into place under the Affordable Care Act. There is now a 3.8% tax on net investment income. So this will include your income from interest, dividends, capital gains, rents, as well as passive income from your pass-through activities such as partnerships or S corporations. And again, this tax, moving forward in 2014, it is in place. It's going to continue to be in place. So it's another place where you're going to want to look to adjust your withholding or your estimated tax payments in order to avoid an underpayment penalty for 2014. Another thing high-income taxpayers would have seen on your 2013 tax return would be reduced itemized deductions and personal exemptions. I actually had a client call me and say, hey, my Schedule A itemized deductions, the total's not right. All the numbers on the form don't add down to the total. And I had to explain, well, that's because your itemized deduction was reduced because of your income level. This reduction applies to married taxpayers with greater than $300,000 in adjusted gross income. So as an example, if you're a married taxpayer and your adjusted gross income was $700,000 and you had 3 children, you probably lost over $31,000 in itemized deductions and personal exemptions this year. So your itemized deductions are reduced by 3% of the amount that your adjusted gross income exceeds that threshold. Your personal exemptions are also reduced. In addition to just losing the deductions, in some cases where your not quite, or you wouldn't have been at those thresholds for the 39.6% tax bracket, the loss in deductions, which increased your taxable income, may have actually pushed you into a higher tax bracket. So again, for the most part, high-income taxpayers didn't have many good surprises on their 2013 tax returns. We did see increased income taxes, increased Medicare taxes, and reduced deductions and exemptions. So not good news from a personal standpoint. What are we looking for or looking at in terms of 2014 tax changes? Well, first of all, many of our so-called tax extenders expired as of the end of 2013. At the current time, these have not been further extended, although actually just today, Dave Camp, chairman of the House Ways and Means Committee, has proposed permanently keeping some of these tax extenders on the books. But at the present time, for 2014, there will be no state and local sales tax deduction. This will certainly impact those of you who live in states without a state income tax, as most of you are probably taking a sales tax deduction on your personal income tax return. The higher education tuition deduction has expired. Enhanced Section 179 expensing and bonus depreciation also expired at the end of 2013. This will be a big change for those of you who have businesses and have been used to being able to purchase equipment and expense it under Section 179. In recent years, that expensing has been allowed to the tune of $500,000. That has dropped down to a $25,000 deduction for 2014. And in addition, the research tax credit has gone away. So we'll see there's certainly a lot of talk in Congress about some of these being extended. That has not happened to date. The Senate Finance Committee has, in fact, approved legislation to extend the provision. So we'll have to see what the House does moving forward. Some other changes that are effective for 2014. In January, the tax court ruled that a taxpayer can make only one non-taxable IRA rollover contribution per year, regardless of how many IRAs the taxpayer maintained. So for those of you who are considering a tax-free IRA rollover, keep that in mind. One per year is now the rule per the tax court. Another thing, Bitcoins have been in the news a lot recently, and the IRS has come out with an announcement that virtual currencies such as Bitcoins will be treated as property for tax purposes, not as currency. And what about, there's been a lot of talk also recently about President Obama's 2015 budget proposal. Again, this is the proposed budget, has not passed yet, but it will give you some sense of where the current administration is going in regards to their theories on taxation and tax rates, deductions, etc. Many of these budget proposals are a repeat of President Obama's 2014 budget proposals, which many of which did not pass or were not included in the final budget. But one of the things that the administration is still looking to do is limit the value of itemized deductions for high-income taxpayers to 28%. So we talked about the fact that your itemized deductions are limited in amount. If your adjusted gross income is over a $300,000 threshold, you're going to lose a certain amount of your itemized deductions. But those that remain, you're still getting a benefit, presumably, of at 39.6% if you're in that 39.6% bracket. What the budget proposal would do, in addition to limiting the amount of your itemized deductions, it would also further limit them by saying you're only going to get to take them to the extent of that 28% tax bracket, not the 39.6% tax bracket. President Obama's budget proposal also includes the Buffett rule. Again, it's been in the news a lot over the past few years. It is, in fact, a rule that would say taxpayers with adjusted gross income greater than $1 million would pay a minimum tax rate of 30%. There's also a proposal in place that says taxpayers with accumulated retirement benefits above certain limits would be prohibited from further accruals and contributions. So again, what the administration has proposed is that they'd like to set an amount that they feel most people could reasonably retire on. That would be the maximum amount for tax deferral in a retirement account, and anything above and beyond that would lose the tax benefit of a qualified retirement plan. President Obama has also included, again in his budget proposal, similar to last year, that the estate and gift tax laws revert to 2009 levels. If you remember when we had the fiscal cliff deal that was signed into place at the beginning of 2013, the estate tax exemption was made quote unquote permanent at $5 million increased for inflation. Gift taxes were also exempted for a lifetime at $5 million increased for inflation. What President Obama has proposed in his budget is going back to those 2009 levels, which included a $3.5 million estate tax exemption, a $1 million lifetime gift tax exemption, and a top estate tax rate of 45%. We currently have a top estate tax rate of 40% for federal estate purposes. So as you can see, many of the tax law changes that have gone into effect, many of the proposed budgetary items certainly would assess a greater tax burden on high-income taxpayers. So, one of the things that we talk to our clients about is it's more important than ever to do tax planning, to concentrate on tax planning, to take a look at your business, at how it is structured, at what benefit plans you might be able to put into place to help ease the pain. But how can you ease the pain? One thing you're going to want to do is look at tax diversification for the long term. We talk about different ways that your income is taxed. As you know, if you're putting money into a qualified plan, you're getting a 100% deduction on that money today. It's growing on a tax-deferred basis, but you know that it's going to be taxed at ordinary income tax rates when you take distributions during your retirement. What you don't know, what those rates are going to be. What tax bracket will you be in? So because of that, we think it's really important to diversify your income streams. Have some of your money in that qualified plan bucket that you're getting the deferral and the deduction on today, but you know it's going to be taxed in the future at ordinary tax rates. Save some money in your after-tax accounts that are more likely to be taxed at capital gains and qualified dividend rates in the future. And put some money in a bucket that will be tax-free in the future, because admittedly, none of us know where tax rates will be with certainty. Another thing that you should do is make sure you're operating under the appropriate corporate structure. Make sure you're taking full advantage of that corporate structure and the tax benefits that go along with it. Many of you might be operating as an S corporation. Make sure you're taking advantage of the benefits that go along with that. For some, you may be able to operate your business under a multiple entity structure and be taxed in different ways in order to take advantage, for instance, of benefit plans that you can utilize with a C corporation, but also flow-through benefits that you may get as a partnership or an S corporation. In addition, make sure your investments are managed with a focus on the tax drag. You know, we see clients frustrated each and every year by investment managers who don't keep an eye on the tax impact of their investments. Many of them are seeing big tax bills come about from capital gains that are generated within mutual funds. You know, active investment management can allow you to reduce the tax impact and work with your investment manager to minimize tax impact of your investments, thereby increasing the amount of gain in your investment accounts on an after-tax basis. How can we help at OJM? Well, as I mentioned, we're a multidisciplinary firm. We have a team of experts, each in our own field. I might look at your situation from a tax standpoint. Our partner David Mandel might look at your situation from an asset protection standpoint. Jason Odell might look at it from an economic and financial planning standpoint. And together, we will cooperate and collaborate with you on what makes the most sense and what's the most important to you. So we do take a focused approach to tax planning, retirement and insurance planning, and asset protection. We have investment professionals to advise you on your investment income with a focus on the tax impact of those investments. Next steps for you, we'd love for you to contact us to get a free copy of one of our books, For Doctors Only or Wealth Secrets of the Affluent, or any of our other books that we referenced earlier in the presentation. You can also get a link to download those books to your Kindle or iPad. We'd love for you to sign up for our e-newsletter, and we're also offering you a free consultation. If you're interested in that, please contact David Mandel at the number shown on the screen or via email. And again, we really appreciate your time today, and thanks for joining our webcast.